Okay, so who hasn't, daydreamed about cracking the stock market code?
True.
Right. I mean, it's tempting, right? Especially online where everyone's got the secret sauce, those guaranteed returns, algorithms that are just printing money.
Yeah.
But the source we're diving into today, they're calling BS on this whole stock market prediction game.
Right.
And get this, it's not like they're just, skeptical from the sidelines. They went all in on complex algorithms themselves, learned Python, the whole 9 yards.
Yeah, they really went down that rabbit hole.
Exactly. So when they say it's fundamentally flawed, they're speaking from experience, which is kind of mind-blowing.
What I find so interesting is that they fully bought into that learn Python, train a model, profit myth. Imagine thinking you can just feed historical stock data to a computer and it'll magically predict the future, like some crystal ball.
So are you saying all those charts and graphs, the ones everyone obsesses over, they're not the secret sauce? Because honestly, I've been tempted by those online courses that promise to turn anyone into, a day trading wizard.
It's not that those tools are useless, but they often miss the bigger picture. Daily stock prices are just one tiny piece of a much larger puzzle.
Okay, I see what you're saying.
Think of it like this. Trying to predict an entire movie based solely on the opening credits. You might get some things right, but you're missing the whole story.
Ouch. Yeah, I've definitely been guilty of that kind of thinking. So if it's not about staring at charts all day, then what are we missing? What's the alternative?
Well, our source really emphasizes this idea of remembering that stocks aren't just these abstract symbols or lines on a graph.
Yeah.
They represent actual pieces of ownership in real operating businesses. And that's where the real focus should be, on understanding the underlying businesses. It's not so much about trying to time the market perfectly, but about finding companies that are like well-oiled machines.
Companies that are consistently generating value, right?
Exactly.
So instead of trying to be some sort of Wall Street psychic, it's about understanding the actual businesses, right? But how do we go about doing that? What should we be looking at?
That's where all those financial indicators come in that the source is always talking about. Things like revenue, net income, free cash flow, earnings per share.
Okay.
It sounds kind of jargony, but really they're just telling a story about the company's financial health.
This free cash flow thing, why should I, as an investor, really care about that?
So think of this way. You've got revenue, right? Which is all the money a company's bringing in.
Right. Okay.
Free cash flow is what's left over after they've paid the bills, invested in growing the business. It's the cash they actually have on hand to, say, pay dividends to shareholders, like you buy back their own stock, or even make strategic acquisitions.
Makes sense.
All good things if you're playing the long game, right?
So it's like after you pay rent and groceries, the money you've got left in your pocket to actually, do stuff with.
Exactly. And that's why our source is such a big proponent of looking at a company's track record. Are they consistently generating more free cash flow year after year?
Yeah.
Because that's usually a good sign of a healthy, growing business.
Okay, yeah. And what about these other indicators like net income, earnings per share? How do those fit into the picture?
It's all part of the same story. So net income is essentially what the company earns after all expenses are paid. It's like your take-home pay.
Okay.
And earnings per share, well, that just breaks down the net income on a per-share basis.
Mm.
So you know how much of those earnings are allocated to each share of stock you own.
Our source mentioned some pretty relatable examples: McDonald's, Walmart, Microsoft. I mean, we all know these companies, right?
Right.
But if we're thinking about them as investors, we should be looking at these financial indicators.
Absolutely. Instead of getting caught up in the hype or the day-to-day stock price swings, think about these companies as businesses. Are they growing their revenue? Are their profits healthy? Are they generating cash that they can reinvest for future growth?
Okay.
Those are the questions that will lead you to those well-oiled machines we were talking about.
Mm-hmm. It's interesting. Our source is totally dismissive of what they call technical analysis voodoo magic, like those complex chart patterns, indicators.
Oh, yeah.
They basically say that none of it really matters if the business itself isn't sound.
And they have a point. You could have the most sophisticated trading algorithm in the world, but if you're betting on a company with shaky financials, it's like building a house on sand.
So we've gone from trying to outsmart the market to really understanding the businesses, but it's got to be more complicated than that sometimes, right?
Right. There are always exceptions, and we know the market can be irrational, especially in the short term.
Yeah.
The source uses GameStop and Nvidia as examples to illustrate this.
GameStop, Nvidia, those were some of the biggest meme stocks. But I guess this is where we see the difference between hype and actual business performance.
Exactly. Both companies saw their stock prices go through the roof,
Right. Yeah.
fueled by social media and speculative trading, all that.
Mhm.
But their financials told a very different story. Remember those key indicators we talked about?
Yeah.
GameStop's revenue, it was pretty stagnant.
Mhm.
And their free cash flow, well, it wasn't exactly a pretty picture.
So, like, under all the hype, GameStop wasn't this amazing high growth company.
No, they were struggling, actually, to generate consistent value. Now, Nvidia, on the other hand, they were a completely different story.
Okay.
Growing revenue, healthy profits, strong free cash flow. They were a company firing on all cylinders, developing cutting-edge technology.
Which makes sense because everyone wants that.
Exactly. And, this wasn't just hype. They were creating real value.
And that difference in their business performance, that's what we saw happen after the hype died down, right?
Yeah.
GameStop, their rally fizzled out, but Nvidia, their stock continued to climb because ultimately their business was fundamentally strong.
Exactly. It goes back to what we were saying earlier. The market can be irrational in the short term, but long term, it's a weighing machine.
Yeah.
It weighs the actual value a company's creating.
So GameStop was kind of riding a wave, but Nvidia, they were the tide itself.
That's a great way to put it. And, to really drive this point home, the source actually used AI to analyze both companies.
Oh, wow. Oh.
Just based on their financial data. No emotions, no hype, just the numbers.
So the AI, it saw Nvidia as the better long-term investment.
Exactly. Even the AI, without any human bias, recognized that Nvidia's business was just fundamentally stronger.
That's pretty amazing. After this deep dive, I'm definitely rethinking all those guaranteed stock picks I see online. Seems like focusing on those fundamentals, the revenue, the cash flow, like we talked about, that's how you cut through the noise.
Absolutely. Don't waste time looking for shortcuts or trying to outsmart the market. Instead, invest your time in understanding the businesses.
Yeah.
Look for those companies that are generating value consistently, those that are growing their earnings. You want to see a solid track record.
It's about thinking like you own the business, not like you're gambling on, a horse race.
Exactly. And when you invest in those strong companies, you're not just betting on their stock price. You become part of their success.
That's a great point. So to wrap things up, remember those financial statements, they're not just numbers on a page. They tell a story, and it's up to you to learn how to read it.